Okay, I'm going to be looking at Converge Technologies. They are based out of Toronto. They are an IT service provider offering hardware, software, managed services, professional services to mid market clients. The company works with leading technology vendors, has technical expertise in hybrid IT, multi cloud architecture, cybersecurity, analytics, and DevOps. Trades around $3. Market cap around 605 million, does have a 1.95% dividend yield. So what has the company done year to date? We can see its stock price there. So down around 25% on the year. It's also down about 75% from its 2021 highs. Now, the stock has also dropped just around 32%, almost 33% in the past month. The drop is largely a result of the company's October 24th announcement that it was lowering Q3 guidance, as we can see right there. Let's take a look at the actual release and the key points from this. They pre-released the following. Gross profit was going to be approximately 158 million, down about 9.1% from Q3 2023 versus the prior guided between 172 to 178 million. It's a 10% reduction at the midpoint there. And adjusted EBITDA would be 32 million. That's down 22% from Q3 2023 and about 29% reduction at the midpoint of what they were guiding at for the quarter in itself. The reduced results were attributed to a few factors. Certain billing, which were expected to land in Q3, have been pushed to Q4 and into fiscal year 2025. Additionally, there was lower than expected demand in North America related to data center, networking, and storage solutions due to budget constraints, as well as IBM's mainframe product cycle and a challenging year-over-year compare versus last year. In addition, the endpoint user device refresh cycle has been pushed out again, with expectations that buying will ramp up by mid-2025. A good deal of negatives here, though, in the mid and near term. So let's look quickly at the numbers. These are from the previous quarter, Q2, sorry, as we see here, the 3-month period. The numbers were okay here. Although you can see revenues again were down, and net loss was significantly higher. Adjusted EBITDA was higher, but we'll talk a second about if that's a good way to value a company like this. We look at the balance sheet here. So net debt position, cash is 174 million, debt 425 million. So net debt is 251 million. Revenue, again, so we can move on here. We can just go to valuations for this company. Valuations here, adjusted EBITDA to EV was, or based on a forward basis into 2025, is about 5.7. Enterprise value to free cash flow is 19.4. And the PE, we can't calculate it on a trailing basis because there are no earnings here. Again, while the EV to EBITDA may look attractive, we do not expect much growth in EBITDA and view EBITDA in this case, and again, this is adjusted EBITDA, we view it as a less than optimal way to value mid-cap to small-cap companies with net debt and low margins. The free cash flow multiple shows a less than attractive valuation here. To give you, particularly given the growth expectations, to give you an idea of why we think this is not a good margin for the business, we can compare it to other, it's not even a comparable type business, but it is a small cap, a software business, VitalHub. We were able to buy at this time last year at under 10 times free cash flow. Despite the significant drop in Converge's share price, it still trades at around 20 times. So VitalHub we bought this time last year at half the multiple. Well, there was growth organically in the business where we don't see that in Converge. So VitalHub over that period of time is up 220%, where Converge continues to drop. The PE, again, I said it's non-existent because there is no earnings. So let's just have our conclusion here. Converge faces weaker end market near term and midterm, and a drop in revenues is expected. Earnings, EBITDA, and cash flow, they're all expected to drop. Optimistically, we could see a slight recovery in fiscal year 2025, but the analysts told us that was going to happen again. We were going to have growth in 2024, and it doesn't look like we're going to be there this year. This is a company, again, with significant net debt, and expected adjusted EBITDA margin in the next quarter is expected to be 5.2. Then for the full year, 6.2, and next year, just 6.6. So those are relatively low, or they're very low, in our opinion, adjusted EBITDA margins. This is a business that continues to lose money, again, on an accounting basis. Converge just does not meet our basic criteria. Despite this, the company receives plenty of analyst coverage. It's a low margin, low organic growth, now debt-heavy business that really does not have a compelling investment case. But again, it receives all of that coverage because it does consistently what Bay Street and the big banks are looking for. That's raising capital, making acquisitions, transactions that make big banks and brokerages money. But the business is not making much money, and shareholders have unsurprisingly seen significant capital destruction over the past 3 years in the stock. Perhaps the business is sold one day, but this is not the structure of business that we would recommend and see as driving long-term value for our clients. Because Converge is well covered on Bay Street, we expect to continue to field many questions on the company. But as we've stated in the past, unless something fundamentally changes with the business, we expect to continue to advise investors to avoid Converge.
Yeah, and that's the thing. Like, they're just, we've said this last time we covered the stock, or I covered it. Their goal is to expand those adjusted EBITDA margins. But in 2020, it was adjusted EBITDA margin of 5%. I think in early 2022 they ended up getting a couple quarters at just shy of 7%. But now we're in, like Ryan's projections were showing for 2025.
Last quarter, yeah, and then
in the last quarter we're again looking at this exact same range, and it's just, how can you get excited about a company?
Even if you're going 6 to 8, like, we consider 10% low.
Exactly.
So, I mean, and again, just to put that in perspective, we're considering
That's
10% low. And this is an adjusted basis too. So there's, the company just isn't significantly profitable. And when they came to the market, they did a ton of acquisitions. They grew not organically, but just by acquisition and from raised capital. And then they finally went into debt doing that because they kept making acquisitions, shelling out capital, and then issuing shares. And now you get into a position where they can't grow anymore because they're not able to make acquisitions. And now they're selling off and trying to pay down debt. And now there's a lack of growth. It's just, we just low margin business, no organic growth, basically is what we see right now. And, it's not the type of business that we are looking to invest in. There are worse businesses out there than Converge. Far worse, but it just doesn't meet our criteria. I think you're muted, Brett.
Yes, I was. When you are looking at these software companies, the thing which investors and anyone who's really looking at them love is the high margins, and that just doesn't exist here. So
they're a reseller, basically.
Yeah, exactly. And that's really the key difference I wanted to mention, which Ryan beat me to was that they are reselling it. You're not getting that full degree. You're not getting that 50, 60% gross margin on a company, a software piece, which many other software players will. And that's why you can't value them the same way, which I think quite a few people in the market were seeing them just as they develop their own software. They're not reselling it. They get that full margin, where that's just not the case.
Yeah. All right. I think that beats that dead horse at this point.